Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, January 27th, 2021, and I'm pre-recording this Trading Places Live for Thursday, January 28th. Futures are a bit lower this evening after a couple of big earnings reports, one from Apple, one from Tesla, and of course, after a pretty big Wall Street sell-off on Tuesday. We'll get into all of that in just a minute. Today's agenda, I'm going to go through the daily market recap with you, do a little talking technically. I want to show you, maybe what we can expect in the near term, maybe some downside targets if the selling does continue here over the next few days. Then I want to go into a short squeeze segment, talk a little bit about what we've been seeing in the market recently, all the talk. This is actually nothing new to our Earnings Beats members. We've been providing our short squeeze chart list for the last several months and talking about the merits of trading stocks that are heavily shorted that break out. And so we'll go over some of that. Then I'm going to go into chart lists. Actually, we created some new chart lists for our Earnings Beats community. So not only our paid members, but also those who are receiving our free newsletter. So go over that with you. Get into earnings spotlight. Obviously, as I mentioned, Apple, Tesla reporting, Facebook. A handful of companies raised guidance on both revenues and earnings going forward. And so those are probably going to be worth taking a look at. And then we'll wrap up with 3 you must see. But before we get into any of that, let me take you over to earningsbeats.com. You can see our performance throughout this quarter and since inception in all of our portfolios. Performance has been exceptional. Even after today, our aggressive portfolio up 40% this quarter versus little over 4% for the S&P 500. It's almost 10 times the performance in our aggressive fund. And big part of that is that 2 of our aggressive stocks are among those stocks that are heavily shorted and have been doing extremely well. So a little bit of certainly an aggressive take on investing in the market, but it's certainly proven rather useful. Over here on the left-hand side, this is the subscription to our free Earnings Beats Digest newsletter, Mondays, Wednesdays, and Fridays. It comes out. There's no credit card required. You can unsubscribe at any time. Usually the discussion revolves around earnings, relative strength, those types of things. I do want to mention members of this community, anybody who is a subscriber to the Earnings Beats Digest is eligible to get upcoming earnings chart lists. And I'm going to talk about those later. But if you're a StockCharts member, extra or above, you can take our chart list. We do a lot of research. You can take our chart list, drop them right into your account, literally in about 3 to 5 seconds, which is awesome. So you might want to take advantage of that, but you would need to be a member of our community. So go ahead and type in your name, email address there, hit the subscribe. We sent out our first chart list today in the Earnings Beats Digest, and we'll be doing another one on Friday. So again, definitely sign up for that. And even if you're not a StockCharts.com member, by the way, you can still view the charts. So you just won't be able to download them into a StockCharts account because if you're not a member, obviously you don't have an account. One other thing, though, before I do move on, I want to just mention Saturday, we're going to have an event at 11 a.m. And that event is a day in the life of earningsbeats.com. We've made so many enhancements to our service. We want to walk everyone through. It's really just as much a refresher for all of our members as it would be, kind of a walkthrough for somebody who's new to Earnings Beats and wants to find out a little bit more about what we do. But Saturday at 11 o'clock, we're going to do that. And a little bonus presentation at the end, the January effect. So I'm going to talk about how the correlation works between how stocks do in January and how they do over the balance of the year. I think you'll find that interesting as well. All right, let's move on. The action in the market on Wednesday, it was a brutal day. I've been talking about how the major indices have all been trading above the 20-day, which is above the 50-day. Well, you can see the Dow lost 633 points today, falling down to 30,303. It was actually in my Trading Places Live show on Wednesday morning at Earnings Beats. I talked about the fact that there has been some consolidation. We've been seeing defensive groups leading. We could see a little bit of a selling. And I mentioned specifically the Dow could go down to 30,000. I mean, seriously, after the move we've made, I mean, we were down at 26,000 back in at the end of October. So this bullish period from the end of October through January 18th, that's the most bullish period of the year. What we saw during that entire period was a really strong market. It's okay to consolidate and to pull back a little bit. So I think we could still see a little bit more selling. I don't think this is going to be anything major, and I'll talk about that in a few minutes. But we did see some selling. The Dow down more than 2%, S&P 500 down more than 2.5%. Same goes for the Nasdaq. Mid caps finished flat on the day, and then you had the small caps, which were down about 1/3 of 1%. So all in all, really not that bad in terms of mid caps and small caps. They actually handled the action today pretty well. Down here at the bottom, you can see 5 sectors. These were the 5 worst performing sectors in the market on Wednesday: communication services, consumer discretionary, healthcare, financials, and materials. One group that's absent from that grouping there is technology. Technology, even though we had a big down day, we saw the Nasdaq down 355 points, and the Nasdaq was the worst performing of all the indices. Technology was not really the reason why. We did see a lot of selling in technology, but it was not the leader to the downside. And that's, I'd say that that's probably a pretty good sign. Anyhow, moving on, 10-year Treasury yield. Do want to mention there are some economic reports due out on Thursday. You want to keep an eye out for these. Q4 GDP estimate. This is the first GDP reading, so this is usually the one that gets the most reaction. The estimate, 4.1%. By comparison, Q3 rose 33.4%. But again, coming out of the pandemic, that was not expected to continue at that kind of rate. 4.1% though for the quarter would be pretty strong. We'll see whether or not we can hit that number. That'll be out Thursday morning. Of course, initial jobless claims out every Thursday morning. The number there expected at 875,000. Last week was 900,000. So we're looking for it to tick down a bit. December new home sales, 871,000 units is the expectation. November was 841,000 units. So looking for about a 4% pop there. December leading indicators expected to rise 0.3%. November rose 0.6%. So we're looking for that number to be cut in half. As far as the yield itself goes, we've pulled back right about where I figured we would. There are 2 levels I'd watch. I think the first level is a pretty big psychological level, which is 1%. That's where we had gapped up to early in January before we made the move up to 120. We printed that black filled candle right there. That normally is a reversing sign. We certainly have reversed off of that. So we're back down now testing this 1% level. I think also these prior highs, this was about 0.96, and then these two over here about 0.97. I think this area, and then you got the 50-day moving average moving up. The yield has not closed below that since early September. If we were to go back down below 0.95, we want to be a little careful. We might have to reevaluate things because in my mind, at that point, we're starting to see a lot more money rotating back into, treasuries. And that would suggest that traders are getting a little bit more defensive. All right. So let's go ahead and move on because we got a lot to go over here for the show. I want to pull up the S&P 500. Let's do a little talking technically here. So the S&P 500 been moving up. We rallied off of that late October low. This is what I was talking about. Late October to January 18th. Historically, this has been the best time of the year on the S&P 500. Going back 7 decades to 1950, there is no time of the year better than October 27th at the close until January 18th at the close. That period just ended. Latter part of January tends to be more sideways, kind of flat. And if you look at where we were on January 18th and where we finished today, we're down slightly. No big deal. This is about what we've done in the past. Historically, this is what we would expect. So we went up for a few days. Now we're coming back down. The big picture hasn't changed. And I'll go through some of those numbers with you and explain what I'm talking about there. But looking at the S&P 500, the first thing I would say when we look at this chart, and I annotated here for you, Remember those highs back at the beginning of September? Remember we had this big move up? I wrote an article that sentiment was suggesting that we were topping right there. And I think that was a pretty good call. We ended up going down, back up, couldn't get through, back down, back up. It was 2.5 to 3 months before we really had a definitive breakout above that September high. That was at 3,600. I think potentially, I'm not saying we're going down there, but I think it's possible we could see 3,600. That would be, I don't know, maybe about an 8% correction. That would be pretty steep. The one thing that you have to realize, though, is the market, when it goes down a lot faster than when it goes up. If you look at July and August, it was just kind of this boring move. And then when the selling started, it was like, bam, little rebound, bam, ABC correction. We might do that here. We might go to the 50, bounce a little bit, and have a C move down to the 3,600 level. I'm not sure what's going to happen in the short term. It's really hard when the market's volatility, the VIX picking up again, markets kind of not really in panic mode, but kind of in panic mode today. We saw a lot of pretty steep losses. Whenever the market gets like this and the VIX is on the rise, you have to be careful. Things can move pretty quickly to the downside. But the other signs in the market are telling me we're likely to see accumulation by Wall Street. And that's what I would be looking for. Stick with the best companies. Those are the ones that are going to come back first when the selling is done. Anyhow, the S&P 500 here, you can see that 3,600 level to me is somewhat significant. After we broke above 3,600, we came back down, we tested it. We had a couple other lows in December, got down into the 3,600s, maybe 3,640 or something like that. But I think potentially 3,600 could be a target to the downside. It's something to at least be thinking about. As far as the weekly charts, because I like to go back to the weekly when things start to get a little hairy on the daily charts. I like to try to go back to the weekly because that sometimes will make me a little bit more rational. Sometimes you see all the losses in a day or something, you get kind of carried away. Longer term, the weekly charts, I think, put things in perspective. When we made the big move throughout the summer and we got into late August, early September, I mean, the pullback that we saw, while it looked really bad on the daily chart, it was a 20-week test on the weekly chart. When we came back down at the end of October, right before this latest push to the upside, we went a little bit below the 20-day, but we didn't go below the prior low. I believe the 20-week is always in play to the downside. And if you test the 20-week during an extended move to the upside, usually that's going to be painful on the daily chart. The weekly chart doesn't really look like it, but on the daily chart, you certainly feel it because, back in late August, early September, when we topped here on the S&P, that was a 3-4 week period. It wasn't a couple of days. So, we have to be prepared potentially for a little bit of down, a little bit of back up, a little bit of down, and maybe eventually get that 20-week EMA test, which is also very close to 3,600. So again, 3,600 is kind of like my downside. That would be the extreme. I really don't think we're going to see a whole lot more than that. I'd be surprised if we do go screaming through 3,600. That would be the time maybe to be a little bit more cautious, maybe move to a little bit more cash. But I still believe long-term, by the end of this year, whatever happens here is going to be just noise on the chart because I believe the market's going higher, and I'll talk about that in just a bit. NASDAQ 100, let's look at the same chart. We'll start off with this daily chart, and you can see that top back in September was right at around 12,500. These other tops didn't quite get there, but by the time we finally broke above 12.5, we essentially started our trend to the upside, and notice that 20-day has been holding. We closed almost right on it, 60 points away from it today, which is only, 0.5%. We could be down there tomorrow at the open, maybe below that, depending on how the market opens in the morning. But again, I would be looking maybe down around that 50-day, maybe that price support area around 12.5. If we pull up the weekly chart like we did on the S&P 500, the 20-week, which has been beautiful support on the NASDAQ 100, that sits at 12,262, which is about 900 points still from where we are right now. Again, I'm not looking for 900 points tomorrow. It's possible. But what I'm thinking is that over time, maybe over the next few weeks, if we continue to go through this consolidation period, I do think that downside that is a target that maybe we could be thinking about. Let's keep moving. Now, I said that anything we see to the downside is short term, that I think it's a blip. I really believe it's going to be a blip. I don't care what anyone's saying on CNBC or how many bearish people are out there. I still believe this market is going higher. It's going higher based on fundamentals. Almost every earnings report I see coming in is beating estimates. Tesla was actually one that missed. I was really shocked on that. But their forecast going forward was pretty strong, pretty solid. So I doubt you're going to see a whole lot of selling there. But I want to just show you a couple of things that make me think that this market is not going to go down for very long. First of all, the XLY XLP ratio, consumer discretionary versus consumer staples. This has been, for the most part, moving higher since all the way back, well, really all the way since back at the end of 2008, if I went back a little further. This is 2011 starting off. But we've just consistently been going up. When we went through the trade war issues back here in the fourth quarter of 2018, and then the pandemic, you can see this XLY XLP ratio during this whole period was downtrending. But we ended up holding right at about 1.7, which is pretty close to these prior tops. And it was really just the pandemic, the fear, the panic that was in the market that took it down like that. But look how quickly it came right back up. And look at where we are now, setting new all-time highs. Let me tell you something. Wall Street isn't the last one to know when the market is going to go down. Wall Street is not pouring its money into consumer discretionary stocks just before we're going to have a major downturn. That just isn't the way it works. If you look back at the devastation that took place in the financial crisis, the XLY XLP ratio was falling well before we actually began a major sell-off in the market. So this move to the upside here tells me that this is something that's probably not going to, the selling we see is probably something that's not going to last. The other thing I would want you to take a look at, and this is something I talk about with Earnings Beats members a lot, growth versus value. If we're getting ready to go into this big downturn, would growth be bouncing off of this relative 50-week moving average? I mean, money has poured into growth throughout 2020, 2020 and now into 2021. We just broke out to another, or at least on the weekly chart, we broke out to another high. I'm actually watching 180. I think intra-week 180 is a level. And if we can get through that, the next level is up a little bit above 190. But as this ratio moves higher, again, if we're looking at something down the road, if Wall Street believes that this market is topped and is going to be going down for an extended period of time, would money be rotating like this into growth? I don't think so. So I would be very cautious about growing too bearish. Again, short term, could we pull back? Of course. Market's always subject to short-term moves to the downside. I would just be careful reading too much into this. I think that this is I think this ratio, along with the XLY XLP, is telling us, that we're probably that this move to the downside in the market is likely to be short-lived. All right, let's see, what else do we have here? Let's move on to short squeeze. All right, so talk of the town, GameStop. I mean, GameStop, AMC, BlackBerry, Nokia. Well, we have a whole list of short squeeze stocks at Earnings Beats that we provide to our members each month, updated each month. And these stocks have just been absolutely on fire. I mean, absolutely on fire. You're looking at GameStop here, and you can see this is what happens in a short squeeze. Now, there's a lot of talk right now about, this isn't fair. All these folks on Reddit, are all getting together and ganging up and all going on the long side, and they're posting, what they're doing and so forth. Let me ask you this question. For years, I've been seeing hedge fund managers take huge short positions, driving stocks lower and lower, and then going on CNBC and touting it and then watching others follow suit, only to destroy companies, potentially taking them out of business, employees losing jobs. I've got an issue with that. I don't think folks that make large bets should be allowed to just go onto a CNBC, into a platform like that, and promote their position. I wish we could do that at Earnings Beats. Wow, that would be wonderful if we could just go out and tell the world exactly what we're doing and show our track record, and let everybody follow all of our members. That would be awesome. But not everybody's given that opportunity. I just think what's going on right now is karma. And you can disagree with me if you want, but what's the difference? What's the difference of a huge multi-billion-dollar hedge fund driving the price of a stock down by just continually shorting it into oblivion and talking about it on CNBC? What's the difference between that and a group of investors with a similar amount of money combined that are driving a price the other direction and talking about it? I don't see really a whole lot of difference. If anything, I don't know if you saw the news after hours, but AMC is raising money based on this huge move in their share price. Let me pull up AMC. So AMC, look at this huge run today, from under 5 to over, or right around 20. It was up 300%. So you know what AMC did? Pretty smart management. They came out after the bell and said, we're going to file an offering. We're going to raise some capital. This move to the upside probably just saved the business of AMC. Whereas those hedge funds, when they go on and they're shorting, they're ruining companies. They're ruining jobs. This move is doing the opposite. It's allowing the company to raise capital, and it's saving jobs, saving a business. I would argue that what's going on at Reddit's a whole lot better than what has been going on with hedge funds that like to short. I mean, you've got somebody like Pershing Square Capital CEO Bill Ackman. I mean, he gets free press on CNBC just about any time he wants to go in and talk about a stock that he can't, that he believes is way overvalued. Well, these folks are making their voices heard, and they're saying these companies are way undervalued. Who's right? Time will tell. I have no problems whatsoever with what's been taking place. In the end, this is pure speculation. Is AMC worth $20 based on its business model right now? Probably not. I mean, seriously. Let's go back. Think about the pandemic that's hit. Look at this stock now. It's all of a sudden at about a 3-year high. Should it be? Of course not. Not based on fundamentals. But this group of investors got together and they'd said, hey, we're gonna buy the heck out of this company. And now, as a result of that, company comes out and says, we're going to raise capital. All of a sudden, we're not in trouble going out of business anymore. It's almost like one is helping the other and feeding off of one another. I don't know. Everybody has a difference of opinion there, but I actually kind of like what's going on. Let's move on to, let's look at this upcoming earnings chart list that I was referring to. Sign up. Again, go to Earnings Beats, sign up for this newsletter, because we'll give you the link and the password where you can go in and download these chart lists. But let me just show you, for instance, what we did is we created a chart list of companies that will be reporting earnings. For instance, for today, our members and those on the EB Digest were able to download this chart list into their account. And what it represents are all the companies that reported Tuesday evening after the bell and Wednesday morning before the bell into one chart list. So Microsoft, Texas Instruments, Starbucks, Advanced Micro Devices, Canadian National Rail, and so forth, all the way down the line. 0001 to 0026. Those were the ones that reported Tuesday evening. 1001 to 1030 were companies that reported Wednesday morning. All of them had new information when the market opened on Wednesday. So as a result, we could do this view all. If you have this in your account, hit the summary, and you can see which companies actually responded well today to their earnings and which ones didn't. And you can do this at 9:31 in the morning to get a really good sense right at the market open, which stocks are being bid up, which ones are selling off as a result. So it's a pretty cool feature. Tomorrow, the one that we have available here, you can see there's Apple and Tesla, Facebook, ServiceNow had a great report, by the way, and so forth, right down the line. 0001 down to 0049 reported Wednesday after the close. 1001 to 1053 report Thursday morning before the open. You got them all in one chart list. I think it's a great idea. Make sure you sign up over at Earnings Beats so that you can get that. All right, let's talk about earnings here for just a couple minutes. Apple, Tesla both reported. Apple down 3% after hours. I don't know that they could have done much more, to be honest. $1.68 versus $1.41. They blew away bottom line. They broke down their segments. I was looking at the revenues. The iPhone revenues were almost 10% above expectations, and that's 2/3 of the company's business. But literally almost every segment higher than expected revenues. Their margin was a couple percentage points above expectations, just knocking it out of the ballpark. And yet the stock down 3% after hours. I love Apple back in the mid 150 or 130s if it gets back down to that 20-day moving average. Tesla missed. I was actually pretty shocked that they missed. But I'm telling you, they're like Amazon. They're going to get a pass. They were down after hours 5%, but really, what's 5% when you look at this chart? They're saying that their vehicle sales going forward is going to average more than 50% a year, and some years better than that percentage. And they're saying 2021 is going to be one of those years when it's better than 50% in vehicle sales. I think that's an astounding number. I don't think Tesla will be down long. Let me give you a few of these stocks, and I'll give you a couple, and then I'm going to finish with 3 more. We'll just use those for the 3 you must see. But let me give you Lam Research. I've talked a lot about the semiconductors. I mean, this has been one of the strongest areas of the market. Lam Research, AD line's been strengthening. Price has been going up. We had a rough couple of days. Stock was actually down about 1% after hours, but it's a leader, and they blew away the numbers. They came in at 603 versus 564 bottom line. So, earnings per share. So really good beat there. Another one that I thought was pretty good, another semiconductor, and this one I talked to members about recently. They came out 234 versus 203 on the bottom line. They raised guidance, as did Lam Research, raised both revenue and earnings per share guidance going forward. Stock was up. MKSI was up less than 1% after hours. Probably going to go down and test this area of the breakout below 160. I think the closer it gets down to that level, the better this stock looks, in my opinion. All right, 3 you must see. Got 3 earnings. I'm just going to show you they all raised guidance. First one is URI. So this is United Rentals. Stock was up 1% after hours. I think it's going to hold this 220 level. Next one, HOLX, which is Hologic. Hologic, very good support coming in at 70. Stock's up 3% after hours. And then the last one I wanted to give you was AZPN, AZPN. This is Aspen Technology. This is in the software area, had broken out. This stock was up a little over 1%, raised both revenues and earnings per share. Those are the 3 you must see. Everybody have a great day on Thursday, and be back next week. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.